Hello everyone and welcome to another video, in this case for Jane's retirement account, looking at the month of October. As I mentioned before, I'm getting caught up, have a newborn at home, and everything is going pretty well on my end. So yeah, after I get these videos posted, I'm going to be making the November videos. So hopefully those will be done before the middle of the month of November. Again, my goal is to try and make it so that these happen as soon after the end of the month as possible. That way it's as relevant as it can be because of market movement and things like that. So without anything more to say, let's go ahead and move into the numbers. So I'm not a financial advisor. I don't claim to be one. Article represents my personal views and do not reflect the views or opinions of my employer. I do hold a number of positions similar to John and Jane, in this case specifically Jane's retirement accounts, and I do have those listed. And then this is a real portfolio with actual shares being traded. It is not a practice portfolio, and that is why I include so many screenshots from Charles Schwab, because I want to make it clear that I would have to put in way too much work to try and falsify what it is that I'm presenting. So big reason why I do this is because a few years ago, John and Jane were being taken advantage of by their financial advisor, in my personal opinion. And basically what they decided was that they wanted to take control of their own finances and be able to manage it on their own. And that's kind of what the goal of this whole project is to be able to show that yes, you can go to a financial advisor and there's nothing wrong with that. But in the event that you do want to handle it yourself, yeah, there's some work that goes into it, but the question is whether or not it's worth it. So in this case, I offered to help and just asked them that they allow me to document it and be able to educate people in the process, because that is my ultimate goal, is just trying to get people to think about things differently, so that they can take control of their own finances and make things work the way they want to, if they want to. So their background, John retired in January of 2018. Jane retired in the early 2021. Both of them collect Social Security, and as of right now, that is their only other source of income other than what they get from these retirement accounts and the taxable account. So from the taxable account, they take $1,700 a month, and then from John's traditional IRA, they take $1,000 a month currently. So they do have other investments outside of what I help them with, and it's pretty much low risk, bonds, certificates, things like that. And then John and Jane do not have any debt or monthly payments other than basic recurring bills. So something that I think is really important to know is that this isn't just that John and Jane have really strong income and can live a really comfortable retirement. It's that John and Jane did what they needed to do to set themselves up so that they can live a comfortable retirement. I think this is something that kind of gets lost or maybe not discussed as often as it should, is that you can have a bunch of money, but you can also have really bad habits. And in this case, John and Jane have chosen to live a very simple life, and that makes my job working with them really easy. So as far as the accounts go for Jane, so traditional IRA generated just under $1,840 in October of 2023, and that compares with $1,345 in October of 2022, so it was a pretty substantial increase. The Roth IRA was just slightly up, just below $855 of income generated, compared with just under $817 of income generated in October of 2022. So the balance in the traditional IRA is basically flat year over year. So at the end of October, it was just over 405,000, and it was basically right at 405,000 in October of 2022. And then the Roth IRA is down a little bit, so balance of just under 189,000 as compared to just under 195,000 in October of 2022. So I have a typo here, but basically there was a bunch of dividend increases that were done. I guess I forgot to put the actual number in there, but that'll be on the next slide and we'll go through those. But no companies decreased their dividend payout during this time. So we had a grand total of 8 companies that paid some sort of increased dividend. So in this case, we have American Tower Corporation was up 3.2%, Avient was up 4%, Iron Mountain was up 5.1%, Main Street Capital was up 2.2%, Altria was up 4.3%, Philip Morris up 2.4%, Realty Income up 0.2%, and WP Carey up 0.2%. So pretty good across the board in terms of the number of companies. Nothing, really substantial other than, Iron Mountain, but also we've been seeing consistent increases throughout the year from Main Street Capital. So pretty happy with them. Also with American Tower, they usually do some pretty regular increases as well, versus many of the other companies. Well, most of the companies on this list are doing increases more than once in a year. But versus a lot of other companies that maybe do have larger dividend increases, but only do it once a year. So the next several slides, I'm going to walk through what the gain loss looks like for each of those individual positions, and just talk about them a little bit more in depth. So with American Tower, things have turned around quite a bit here in the last couple of weeks, I would say. So American Tower, we sold off quite a few of the high cost shares, and now are sitting at a very low cost basis when it comes to the remaining shares that are held. We still have 60 shares, so this is accurate as of the time that this image was taken. But in total, since April of 2021, American Tower, we've continued to increase the position, but it's generated $752.15 of dividends. And one thing I'd like to point out is that its major competitor, Crown Castle International, which we also have holdings of in John's accounts, is American Tower has been performing quite a bit better. So Crown Castle fell off quite a bit. There's some operational issues that were going on, and most recently the stock price has made a huge recovery for Crown Castle, but a lot of that has to do with some large shareholders trying to get some changes made on the board in the direction of the company. So yeah, the nice part is that we're sitting at a pretty solid gain with American Tower. So it kind of goes back to the whole reason why we trim it back, add more shares when the price drops below a certain point, because then even though American Tower was sitting at a pretty big loss just about a month ago, right now it's doing very well overall. So Avient, another example of a company that we are, we continue to add as shares hit their lows here. So you can see where it's recovered quite a bit in the last couple of weeks as well. But as far as the loss goes, it's still, the recovery has not been great enough to offset that. But we did add more shares here at $31.67, and as the price recovers here, we're going to look to trim back some of these higher cost shares here, and that'll just put us in a better position over the long run. So in total though, Avient since October of 2020 has generated $1,063 worth of dividends, and so yeah, I still like the company, and I still think that it's doing well, and it's made a pretty major acquisition recently. I shouldn't say recently, within the last year. But yeah, we like the direction, we like what the company does. So and then for Iron Mountain, we actually trimmed back Iron Mountain in John's retirement account, or actually, sorry, in the taxable account we did. But in here, as you can see, we're sitting at a very low cost basis because we're basically at a potentially almost 100% capital gain on it. So in total, since January of 2020, with Iron Mountain, we've collected about $2,800 worth of dividends. And so, if shares were to pull back to like the $50 share range, I would definitely be much more interested in buying shares. But as of right now, we're sitting at the 52-week highs. And even though I think things look promising, I'd rather wait for a pullback before adding more to that position. And then for Main Street Capital, we hold shares in both Jane's traditional and in her Roth IRA. So the left hand is the traditional IRA, right hand is the Roth IRA. And so you can see that the Roth IRA in particular, we bought shares at their absolute lowest during the initial phase of COVID. And that's part of the reason why it's sitting on such a massive capital gain from that purchase right there. But otherwise, the amount of dividends that have been collected from Maine is pretty substantial since December of 2019. Just under $5,000 basically. So we'd be looking at adding more shares if they dropped under 35. It happens every now and then, but usually doesn't last very long. And then Altria. So Altria has been a pretty poor performer stock price wise. Over the long term, it's been pretty stagnant, I would say, in the last year. Actually, sorry, more like I guess going on 2 years. But the dividends that it produces is still pretty substantial. They still continue with the regular increases. The payout ratio is safe. It's really more the regulatory atmosphere that would concern me the most. You see in some countries they're proposing, bans on youth smoking and things like that. And so it's kind of interesting to see, with companies like Juul that Altria purchased and turned out to be a total flop. That they're trying to find new products to be able to continue making tobacco available to people. And I know some people really have an issue with vice stocks, but I'm kind of the mindset that people can make their own choices, and if they want to choose to smoke, that's on them. And so anyway, they offer a service to people, just like alcohol, just like gambling, just like all kinds of things. And so I'm not going to judge one as being worse than the other. But, at this price, we're not really interested in adding. It's just, again, there's just too much volatility potentially in the regulatory environment. So with Realty Income in the traditional IRA, so it in total generated just under $1,450 of dividends since December of 2020. And I'd consider adding more, but I'd look to potentially sell off some of these high cost shares as the stock price recovers. So if it drops under 50 again, I'd definitely be interested in buying. I know that the acquisition recently of Spirit Realty is there's a lot of moving pieces going on right now, but combined across the taxable portfolios and all of John and Jane's retirement accounts, they've got a pretty substantial position in Realty Income. So I guess I'm not looking to necessarily jump at more shares, but if they hit the right price range, I'd definitely be willing to do it. So for WP Carey, since January of 2020, it's generated a little over $3,200 of dividends. So we actually added shares right before they announced the spinoff of Net Lease Properties, I think is the name there, which, by the way, we sold off all those shares. I just don't, it's one, it wasn't big enough of a position to justify, and two, I'm not interested in adding a new company that's trying to figure out their financials and all of that. I just don't see it as being super beneficial. I think the stock price has actually made a pretty strong move up, but like I said, it wasn't a big enough position to really warrant digging into it. So we've been seeing the negative news wear off. I mean, you can see the price at the time that I took this screenshot, and the price right now is up quite a bit, sitting at $63.68 at the time that I made this video. So I still see a good future for WP Carey. I know a lot of people were super negative after the the spinoff, but I don't think that they wouldn't have done that. Their management team is too experienced to have just done a spinoff without having rationalized what the benefits of it are. So. And going back to WP Carey real quick, we had sold off quite a few shares around like the mid $80 a share range. So the other thing too is that we were able to take advantage of selling shares at a price that was completely unjustified. The $85 a share range, I think it almost hit $90 a share, maybe even did hit $90 a share, was just way too much. And so we also were able to take some gains off the table and wait for the stock price to drop back down again. So again, capital recycling and the importance of it. So in the traditional IRA, we had added $10,000 to the money market. That is now sitting at $40,000, whereas it was $30,000 before. We also had the purchase of Enbridge at 52-week lows. That stock price has moved up quite a bit since then as well, and so that is all moving in the right direction, and that ended up being a real good buy. We did sell Philip Morris. Again, the regulatory environment's getting a little bit concerning for me. Share prices right now, I think, are a little bit above the price that we sold it at. But I wouldn't be interested in buying more until I saw it meet like the mid $80 a share range. Would be when I'd look to add more, but that's part of the reason why we made such a substantial sale here, was just to reduce that exposure to that. And plus with Philip Morris, we can invest in a CD and achieve essentially the same yield, and that's really more what I'm concerned about with a lot of these stocks. So if I can get that from a CD with the safety and not have to worry about the regulatory environment, then I am all for it. So for Simmons Bank, we had a CD, and so that's good through April of 2024, and at 5.4%. And then we sold some of the General Mills shares, and then also, I apologize, we have Crown Castle in John and Jane's account, or John's account and in Jane's account. In both their retirement accounts, they hold a position there. So as far as the trades go in the Roth IRA, you can see that it was a very busy month going here. So with Essex Properties adding more there, PPG adding at 52-week lows. T Rowe, we bought it a little bit too soon. I wish I'd held on just a little bit longer, but T Rowe is actually back to $102 a share. So we're sitting in the positive now on this one. And then for Nextera, also added at the low, or at least near the low, and the stock price has moved up since then. We did sell out or close the position for OGE, and really that was just to simplify our holdings. I think OGE is not nearly as attractively priced right now as we saw with Nextera and a few other utility companies. So really selling OGE was just a matter of it's not as attractively priced as some of its competitors. So we wanted to reallocate some of that capital to some of these better buying opportunities. New York Community Bank, we sold off some shares and actually had sold them off at the right time. The stock prices started moving back up again, but the stock price dropped down to close to about $9 a share, if I remember. So this was a good opportunity to be able to sell off some of the high cost shares, and we might choose to buy some back. I was hoping it would move below 9 or closer to like the $8.50 a share range, to where I'd be interested in buying more again. But we'll just have to wait and see if that materializes in the future. So RNP added more there, and that was definitely at one of the lower points for the stock price. But it's now since moved up quite a bit more. Real estate investment trusts have definitely performed well over the course of the last month. And then Toronto Dominion Bank, I mentioned we've been selling off some of the Canadian banks stocks. A lot of them just announced dividend increases coming up during their next dividend payout. But their housing market and certain aspects of it have made me a little bit leery. So basically, we still hold positions in Toronto Dominion and Bank of Nova Scotia, but the positions are in also Royal Bank of Canada, RBC. So yeah, I think I think it was a good move to continue trimming these back, but if it moves lower, I'd be interested. I just want to see that price be quite a bit lower than where it's currently at, and then also again another 10 shares of Nextera purchased at pretty much the 52-week lows. So for the realized gain loss, so you can see with Philip Morris when we sold those 100 shares, basically we were taking a small loss across those 100 shares. So we sold pretty much at the cost that we bought it for. And then for General Mills, we sold those at a decent gain, but pretty much flat was the goal here in reducing those high cost positions, but in the case of Philip Morris, just trying to control for some of the downside risk. And then for the Roth IRA, you can see where Toronto Dominion basically same thing, sold at cost. New York Community Bank Corp sold it at I guess you'd say like a modest gain because it's just under $1 a share gain. But OGE was sold at a much larger gain because that's several dollars per share that was gained there. So year to date, if we look at the traditional IRA, long-term gains minus the short-term gains, in this case loss. So you can see where the net gain is very substantial. But we're talking about total proceeds. This is how much capital has been recycled through the account, and what the cost basis was. So we have reallocated a significant amount of funds, and you can see that in Jane's, in the Schwab money market and in the certificates of deposit. That's where a lot of the money has been shifted to. So sold out of stocks and moved into fixed income instruments. And then for the Roth IRA, similar story, but not nearly as substantial, but also the account doesn't hold as much capital. But we had a total proceeds of $61,000, cost basis of $47,000. So sitting on some pretty substantial gains from the positions that have been reduced there too. So for the year-over-year comparison with October, we have ADC Preferred Series A and oh my gosh, I'm drawing a blank on ARE, Alexandria Real Estate. Both of those positions have basically more than doubled. We've done a small increase in Avient, and then also we did purchase more shares of EPR Preferred Series E. That's the really high yield preferred series for EPR. And then we added OBDC. Granted, I believe that was under the ORCC ticker symbol prior to this. But I did want to add that in there that it wasn't reporting any income for 2022, but it was in 2023. And then down here you can see where now a substantial portion is coming from the Schwab money market and then the CD income. So the October 2023, it includes interest from 2 CDs and the Schwab money market. So we're going to be seeing additional income from the $10,000 that was just invested into the money market, but also there was another CD purchase that was made, and that interest income had not been reflected on here yet. And then, oops, looks like I forgot to change this title right here. So this is year-over-year comparison for the Roth IRA. And so we have ADC, AMT, and RNP. You can see that those positions were increased significantly based on just how much income was coming from them. Significant reduction in the size of Toronto Dominion, so you can see where that income has gone down substantially. And then also we had the elimination of NetApp and Cinex Corporation from the portfolio, both of which accounted for a relatively small amount of dividend income, but still makes up some of the reason why the increase. I shouldn't say it's not substantial, but why it wasn't more substantial. And then the full year comparison. So basically, we're estimating a 9.7% increase in the traditional IRA dividends, and that's up from 9% in September. So that's a move in the right direction. And then an estimated 4.2% increase in Roth IRA dividends, and that's up from 3.7% in September. And that is also a move in the right direction. And just remember that year-over-year increase in estimates in yellow do not factor in CD income. So I like to err on the side of safety, which is why I always hope to see that these numbers are increasing. But when you think about the 9.7% and the 4.2%, that's basically across the board, in a sense, the increase year over year in dividend income being made. And if we were looking at a 9.7% increase in income and a 4.2% increase in income, that would be considered pretty good, I would have to think. May not be as good as what we've seen in some previous years, and you'll see those numbers here in a little bit, but still in the right direction. Because in John's account, one of his accounts, I believe, is sitting in negative, but there is an explanation that goes with that. And I believe I'll get into that in his video. So account balances, month-end balances down, but the traditional IRA was flat compared to the same point in 2022. And by month-end balances down, I meant in the Roth IRA. It's down month over month. So from September to October, it's down, but it's flat year over year. And then the Roth IRA is down about $6,000 year over year. And in Jane's accounts, no withdrawals have been made. So basically, the numbers that you see, there's nothing that we could add back in terms of saying that it performed better than it did. Because there hasn't been any money taken out of the accounts. So for the traditional IRA, you can see that excluding the first year-over-year comparison, we have typically looked at just over 10% for the increases. Now we might still get there with these last 2 months of the year and how much income is going to be coming in, especially from the certificates. So you can see that still just under double digits, and is in alignment with what we've been seeing in the account. So 10% increases every year in income in retirement is definitely what I would consider to be good in my book. And I would say that John and Jane are pretty happy about too. So also, again, excluding this first year here, you can see that there's a little bit more variance in the Roth IRA. The Roth IRA was a little bit more impacted in terms of the stocks that were in it due to COVID. So maybe some of them reducing their dividends or it just depended on what positions we had at the time and how much we were trading out of things. So, but the good part is that it's moved in the right direction. And after two 20+% increases year over year, being at 4.2%, if we were to hit 5%, I would say that's pretty solid. So we might get to 5%, might be just below 5%, but I still expect it to be on the positive side. And then the cash balance comparison. So for the accounts here, you can see where on the traditional IRA there was a pretty big drawdown here. A lot of that has to do with timing, but also money being invested into CDs. But I would say that if you look at the average balance year over year, we are now holding more cash in the traditional IRA, because when I say cash, I am excluding all CDs, all money markets, even though those are technically more liquid of investment types. But we are on average holding more money in cash than what we did when the accounts were first set up. And part of the reason why there was so much in when we first set up was because of how much money was held in cash at the end of those statement periods. And then for the Roth IRA, same exact thing. You can see where we have more cash on hand sitting in the Roth IRA than at any given point, any other point. And that's so that we can take advantage of buying opportunities, but also because we are putting more money into the CDs in the fixed income segment. So right now there is a total of 85,000 in the traditional IRA in those instruments, and another 15,000 in the Roth IRA. And then for the unrealized gain comparison, so we can see that we've moved from an unrealized gain, a pretty substantial one, to a unrealized loss. This number has minimized and moved the other direction over the course of the last month, and we'll see that when I do the November update. But part of the other thing too is if we go back to the shares that have been sold out of it, is that in the traditional IRA there was, I believe, about $30,000 of realized gains that we've taken off the table. So hypothetically, had we left those in there, there's a chance that this would actually still have been in the positive. So we've contributed to the unrealized gain loss moving towards the negative end simply by having sold off shares that were sitting at a gain. And then for the Roth IRA, same thing. The unrealized gain or the realized gains weren't as substantial in the Roth IRA, but still it would likely be quite a bit less than this, or at least closer to zero in terms of the unrealized gain loss. So for the traditional IRA, the current yield on that portfolio as of November 22nd was 4.67%. You can see that in these positions, and sorry that I'm going to see if I can do something to maybe make these numbers a little bit easier to see. I apologize. I'm just now noticing how difficult it is to see some of these. So I will work on that for next video because obviously it's a lot more difficult to try and condense these into a image that actually works on the screen here for people to see because of the size of it. So in this case, the unrealized gain loss was as of November 22nd, and that's why I was saying that the previous loss that you saw on that statement period, it's significantly less, and now I believe we're actually in the positive in the traditional IRA. And then for the Roth IRA, these numbers are a little bit easier to see again because of the sizing of the image, but even this is down or is improved compared to the end of October. So we've been seeing that move in the right direction, and the current yield on the Roth IRA is sitting just over 5% across the portfolio. So on the conclusion here, cash balances have increased substantially, and we've been reducing or eliminating certain positions, especially if they don't offer what we consider to be a compelling risk reward. The equities market right now, to me, is just, it's completely taken off, and to me, it's people are trying to price in the optimism that the Federal Reserve is going to actually make some reductions in interest rates, and I honestly, I personally hope that they don't, and the reason why is because I think it's going to put us in a much more difficult position financially if they do something like that, because we need to see the price of items drop, because right now we're kind of in a game of who's going to break first, and the easiest example for me to use on this is the auto industry. And they're selling trucks out there for $70,000-$80,000 for basically an entry level full size pickup truck, and I mean, the average person does not have the money to be able to afford that. And so these automakers are now issuing huge um, uh, rebates and things like that on these vehicles, because drive by any auto dealership and they're loaded. Even Subaru and Toyota, which are known for having very little days of inventory in the system, are jam packed on their lots. And so, people are looking at it going, okay, well, if I have to pay 8% interest and I have phenomenal credit to be able to buy this car, I'm just going to hang on to my current car. Or, for the people who are retired like John and Jane, where they have the cash to do it, they go, I'm not going to pay 7 or 8%. I'll just buy it in cash. So it really is now getting to be where those cash buyers are less common in the market. And so, because it's what I do for a living, I am seeing just the absolute, roughest applications coming through from these dealerships, and I think it's just something that is going to help car pricing in the long run, because there's going to be a lot more inventory in the system, and the manufacturers are going to have to bend, and the dealerships are going to have to make sure that they are pricing these vehicles appropriately. So the reduction in price of those vehicles is going to help compensate for the increased interest rate, and same thing will apply with the mortgage market, with housing. Yeah, so we'll see where it goes, but that's just my personal opinion, that I think people are too optimistic right now about where interest rates are going to go down, and I don't think that they're going to do it, because they're not a well, there's a lot of people that can definitely make a good point about how the Federal Reserve shouldn't even exist. One thing about them is they do have autonomy, and so they're going to be less likely to make decisions based on political pressure, and more so based on what's actually happening in the economy. So, anyway, enough of that rant. But gains taken on tax deferred accounts like IRAs have no impact. So basically, these shares that have been sold have had no negative impact, because it does require withdrawals to be made out of the traditional IRA for it to actually impact her taxable income. But these other kind of a reiteration of selling off shares that don't offer compelling risk or reward. We're taking those and we're putting that money into money market CDs, treasuries, really primarily short-term types of investments, because we're able to get 5.5% yields on that money, and that is in many cases more than what the dividend yield was associated with the equities that were like pumping out that yield. So anyway, thanks everyone for watching. Sorry this video went so long. There was just a lot of information to report on. Let me know if you have any questions, and I appreciate everyone for taking the time to watch, and anyone comments and subscribes, I also appreciate that as well. Thanks again.